Assignment 1 for Financial Reporting 3. I'd like to go over some of the problems that you'll be working on over the next few days and just give you some tips on how to approach these problems. If we go to problem 1, I'll read this out. Tinder Company has conformity between its taxable income and income before taxes. If Tinder's taxes payable are $165,000 and its tax rate is 25%, what is its net income? So the way to approach this problem is the taxes payable is already given to us, so we don't have to compute that. What this is one of those work your way from the bottom up problems instead of a problem in which you start from the top and get to a solution. It's basically working your way up. So to get to net income, we first start by taking the taxes payable of $165,000 or whatever number is in your problem. You want to gross up that number. So the $165,000 divided by 0.25 gives you $660,000. But that is not your net income. So if you see the solution here, you're going to see that the $660,000 is your taxable income. To get to net income, we have to subtract the taxes payable from taxable income. So taxable income minus taxes payable equals net income. So simply take the taxes payable number, divide it by the tax rate to gross it up to get to taxable income. Then take your taxable income, subtract it by the taxes payable, which is a given in the problem, to get to $495 net income. Problem 2. Tinder Company's income before taxes is $380,000 and its tax rate is 20%. Tinder included $56,000 in non-deductible fines in its $380,000 income before income taxes. There are no other book tax differences. What are its tax expense and taxes payable? What is its net income? So the solution here to compute the income tax expense, we are told that income before income taxes is $380,000, but $56,000 in non-deductible fines in the $380,000. As you've learned in the text, that fines are not deductible for tax purposes. So if $56,000 were deducted on our financial statement and it's part of the $380,000, we have to add that back for tax purposes to get taxable income of $436,000. The tax rate is given at 20%. Therefore, the income tax expense is 20% of $436,000 equals $87,200. That's the income tax expense. The computation of income tax payable is going to be the same because this is a permanent tax difference. So Tinder's net income is $292,800. It gets that amount simply by taking the income before taxes of $380,000 and it subtracts $87,200 in tax expense to get to the $292,000. Let's quickly review our permanent book income versus tax income differences. On this spreadsheet, we basically do a reconciliation. When book income is greater than tax income, for that to happen, let's assume we both start with the same income for book and tax purposes. Under the tax code, we do not have to declare municipal bond income right here in our taxable income. But GAAP basically makes us record muni income as income. So that gets added to our book income. We normally include dividends for both tax and book, but in this case, the tax code allows us to deduct what's called intercorporate dividends, dividends received within our own company. It allows us to take a deduction for tax purposes, but not for book. Many companies have life insurance proceeds. Those proceeds usually life insurance companies have life insurance policies on key employees and officers. So if someone passes away, the company will get life insurance proceeds. Generally accepted accounting principles require that we record it as part of our income on our books. The IRS allows us to not record it as income. Next, the IRS allows us to deduct what's called domestic production activities. It allows us, it's basically a tax credit, usually in the energy and exploration industries. We can deduct it for tax purposes, but we can't for GAAP. So these items here basically are included in our book, and some of them are not included in our book, and vice versa. And that's where the book income is greater than tax income. Conversely, the book income will be less than tax income. Let's assume we start with the same income per our books and tax. GAAP allows us to deduct fines and penalties as ordinary expenses, but we can't deduct them for tax purposes. Certain meals and entertainment we can deduct on our books, but the IRS would not allow us for tax purposes. Life insurance premiums, when we pay premiums on life insurance, they're deducted as expenses on our books, but we can't deduct them as expenses for tax purposes because the income doesn't get taxed, so we can't deduct the premiums for tax purposes. And last, any municipal bond commissions that we incur to buy the muni bonds, we can deduct as an expense on our books, but is not allowed on the tax purposes. So therefore, in this case, the book income is going to be less than the taxable income. So that's a review of permanent tax differences. Problem 3. Yugo Santos Puppet Company acquired a new plastic molding machine at the beginning of the current year for a cost of $396,000. The asset has a 6-year useful life and is depreciated on a straight-line basis with no residual value expected. The company uses double declining balance method on its income tax returns. The company is subject to a 40% tax rate. Compute the deferred tax portion of the income tax expense for the first 2 years. So I want you to complete the depreciation and the accumulated depreciation, both straight line and for the tax basis, which uses a double declining balance. So as you can see, under the depreciation under book, the straight line is very straightforward. It tells us the cost is $396,000. divided by 6 years of useful life. So on a straight line basis, 396 divided by 6, or whatever number you have in your problem divided by the useful life, will give you depreciation expense each year. So in this case, straight line is $66,000. Now to do the tax, what you have to do is go back to your depreciation models from your prior class and do the depreciation for double declining. And to do that, you're going to take the straight line of 6 years and take basically 6 years is basically 1/6. If your problem is 4 years, it would be 1/4. If it was 3 years, it would be 1/3. So you're going to take 1/6. Double declining means double it. So take 1/6 and double it, which in this case is 1/6 times 2 equals 1/3. So if the useful life in your problem is 4 years, you would take 1/4 times 2. Which would be 1/2. So in this case, 1/6 times 2 is 1/3. So simply take 396,000 times 1 divided by 3 equals 132,000. And that's where this number comes from. The following year, because it's based on the net book value, double declining is going to be the 396 minus the 132, which is year 1, as you accumulated, times 1 divided by 3 equals 88,000. Your accumulated depreciation under tax purpose for year 1 is 132, and in year 2 it's the 132 plus the 88 equals 220. Your accumulated depreciation for book purposes is going to be 66,000 from year 1 plus 66,000 in year 2 equals 132. Basically the book basis is 330, which should be the 396 minus your accumulated depreciation of 66,000, and then year 2 it's 396 minus your accumulated depreciation of 132,000, which is 264. On the tax, your book basis for your asset is going to be the 396 minus the 132,000, which gives you 264. And you're going to do the same for year 2. 396 minus your accumulated depreciation of 220 gives you 176. The book tax difference is going to be book minus 132, and 132 minus 220 gives you the 88. This is going to be a tax liability, tax deferred liability. The reason is because for tax purposes, we're going to take more depreciation off our income than GAAP. So as you can see, the depreciation is greater under tax because it's an accelerated double declining method. it's lower under GAAP. So we'll be taking off more depreciation expense for tax purposes off our income. So that means we are saving more taxes in the early years, only to have to pay more taxes in the latter years. And therefore, we're creating a tax-deferred liability. So, in year one, we basically have the $396,000 cost, accumulated depreciation of $66,000. The carrying book value is $330,000. Per the tax basis, it's the same cost, but our depreciation is going to be $132,000, which gives us a tax basis of $264,000. The difference is $66,000 times 40%, which equals our deferred tax liability. However, that's our deferred tax expense is also going to be $26,400. In year two, our book basis is $396,000, but our accumulated depreciation now has another $66,000 in it. So our net book value is $264,000. On a tax basis, the $396,000, the accumulated depreciation is now $220,000 to give us a tax basis of $176,000. The difference is $88,000 per our tax rate of 40%, gives us a deferred tax liability of $35,200. Our beginning balance in year one was $26,400. Therefore, our deferred tax expense is the difference of $8,800. So that's how you derive the answer for part 3. Question 4 is a deferred tax asset along with a valuation allowance problem. So in this case, the Bally Inc. booked a deferred tax asset of $70,000 due to a basis difference in warranty liabilities. So our warranty liability, for tax purposes, we're not allowed to deduct them or create the liability until we actually incur the warranty expense. But on a GAAP basis, we can deduct the expense on our books as an accrual. Thus, we are incurring a higher tax in the early years because we can't reduce our income by that accrual. So in this case, our taxable income will be lower per book, higher per tax. We'll have to pay more tax in the early years. We'll probably be paying less tax in the latter years when we actually have to incur the warranty. Therefore, we have a deferred tax asset, which is simply a debit to deferred tax asset and an income tax expense credit of $70,000. In this problem, it says that it is likely we will not realize 40% of that deferred tax asset because a warranty liability expense or accrual is an estimate. So we might be too high on that estimate. So simply take the $70,000 or whatever number you have in your problem and multiply it by the tax rate. So 70 times 40% is $28,000. Create a valuation allowance of $28,000, credit, and then debit income tax expense for $28,000. As you learned in the text, the presentation on the balance sheet would be the deferred tax asset of $70,000 minus the valuation allowance of $28,000 to get a net realizable tax asset of the difference, which is $42,000. The valuation allowance, as you've learned, is a contra asset. The next problem basically tests our knowledge on creating or recording deferred tax liabilities and deferred tax assets. So, the problem reads, installment sales are a normal part of Arch's operations. Depreciation expenses related to a building costing $1,750,000. Income before including any of the book tax differences above is $935,000. Deferred taxes are expected to be fully realized, and as a result, no allowance account is needed. Arch is subject to a 40% income tax rate. So, what they want is prepare the journal entries necessary to record the effects of a tax rate reduction from 40% to 34% effective the beginning of year 2. So basically what we have to do is figure out the differences between GAAP and tax and the impact of the tax rate change. So here they give us some information. Installment sales recognized under GAAP is $508,000. In taxes, $116,000. What's going on there is that installment sales, basically per GAAP basis, can be recognized as they're incurred. But for tax purposes, we could only recognize installment sales when we actually sell it, so it's on a cash basis. But on a GAAP basis, we can recognize the installment sale when we actually ship it. The 2-year warranty cost, warranty expense, we can accrue the expense of warranty with the sale. But for tax purposes, we can only recognize the warranty expense if we actually pay out cash for the warranty. Depreciation expense, again, is recognized based on the method we choose for GAAP, but tax is usually an accelerated method such as double declining. Depreciation is usually straight line. So to go about figuring this all out, basically take your GAAP and your tax per the descriptions in your problem. So you're going to take these two columns and basically line them up against each other. And you'll calculate the underlying difference. The difference between installment sales, GAAP, and tax is this number. The difference between the warranty expense, GAAP, and tax is this number. And the difference in building for GAAP and tax is this number. Now you have to figure out what is a tax-deferred liability and a tax-deferred asset. The parentheses indicates that it is a tax-deferred liability, and a positive indicates that it is a tax-deferred asset. Let me walk you through the logic. Installment sales income recognized. Under GAAP, we get to recognize the sale as it's incurred or shipped of $508,000. So we're recognizing more sales than we are for tax. The tax only allows us to recognize installment sales when they're actually sold. So in this particular year, we recognized and shipped $508,000, but we only get to record for tax purposes $116,000 because we collected $160,000 sales in cash. Under the tax column, we're paying less tax because we recorded less revenue. So if we're paying less tax today, we're going to have to pay more tax in future years. That's a liability. The warranty expense is an asset because under warranty, it's the same philosophy. We get to record the warranty expense as an accrual related to the sale, but we can only, for tax purposes, recognize warranty expense when we physically have to pay out cash for that warranty. In this particular year, we paid out less warranty than we accrued for, so we're actually going to get a tax break here. We're going to pay, basically, because we're deducting less, we're deducting less expense, we're going to have to pay more income tax on our tax basis. So lower expenses means higher taxable income. We're going to have to pay more tax because of this. That basically means we'll pay less tax in the future, which means a tax-deferred asset. Building depreciation is $90,000, but for tax purposes it's $132,000, which means we get to deduct more expense and lower our taxable income for this year for building depreciation. Lower taxable income means we're going to pay less tax this year, only to have to pay more in future years, which creates a liability. So take the differences between GAAP and tax and put it as your difference. Then take 40% of that number. Remember, parentheses is a liability. Non-parentheses is an asset. Take 40% of that number. Now take the new tax rate of 34% and multiply the difference by 34% and basically do the math. The decrease in deferred tax asset or liability. So in this case, the liability increased. So from 156 to 133, 280, we decreased our liability. To go from 8,000 to 6,800, we decreased our asset. And to go from 16,800 to 14,280, we basically decreased our liability. So the income tax expense is $24,840. The deferred tax liability is going to be the $23,520 plus the $2,520 to give you $26,040. The change in the deferred tax asset is $1,200. So your journal entry is simply the deferred tax liability of $26,040, which is $23,520 plus $2,520. The deferred tax asset is $1,200, and your income tax expense is 24,840, which is calculated right here. That's how you would solve problem 5 out of 9.